Hello, ladies and gentlemen, boys and girls. Welcome to a very special interview we've got coming up with our dear friend and cycles expert, Akhil Patel. But before we do that, it is the 21st of March, 2025 today. We have literally just changed seasons. And for those of you who understand cycles, the change of season often brings about many turnarounds, not just in markets, but also in geopolitical events. But before we get stuck into all that, what I'd like to tell you about is our live in-person conference in New York between the 12th and 14th of June this year. It's going to be a tremendous occasion. It's the first time that people associated, the board members and our special guests, including Akhil Patel, one of our keynote speakers, along with Larry Williams, who's just been announced, as well as Peter Eliades and a whole host of other names, are all getting together in person. I'm hoping to be there as well. And we'll be taking a deep dive. We'll be getting to meet you in person and hanging out. And I think there's even a trip to the Irish Bar planned. But before we do that, let me tell you a little bit more about this event. It will be over 3 days. And on day one, our dear friend and director, Ray Tomes, will be looking at cycles in nature and science. On day two, we will be looking at market cycles and trading strategies. And on day three, there'll be practical applications and innovation. And as I say, we've got an incredible array of speakers. We've got Peter Eliades flying in. We've got Larry Williams has just confirmed. Then we've got our own board members and Sherman McClellan as well has agreed to come along. So we're very, very honoured. So I know it's going to be a tremendous occasion. So make sure you come and join us. But enough of that. That is in June, very close to the next change. It'll be 1 week before the next change of season, so we're less than 90 days away. And, a week's a long time in politics, as was once said in Britain. A season is an incredibly long time in this fast-moving geopolitical and financial world. And with that in mind, welcome to our dear friend, Akhil Patel, who is Director of Property Share Market Economics. He is also the author of the best-selling book, The Secret Wealth Advantage. And if you haven't seen that, you have got to go and get that. And also, just in case you want further resources, Property Share Market Economics, go and have a look at that as well. After you've watched this, though, please. Right, so what we're going to do here, Akil is one of our keynote speakers. He'll be coming along in June, so don't give it all away just yet. But this is really important. Now, let me just give you a bit of background, then we'll get Akil rocking and rolling. There is an 18.6-year cycle that our beloved founder, Edward Dewey, really put down as the basis of so many different recurring events, be it geopolitical, be it economic, be it in nature, be it to do with the different birth rates and of different types of species, etc. And you can halve that at around about just over 9 years. And this is a very prominent cycle. Now, we're very lucky to have Akil with us, who really has taken a very deep dive into this. And through Property Share Market Economics, they've looked at how this applies to the real estate cycle. But I can tell you, having read The Secret Wealth Advantage, and also having known Akil for quite a while now, well over 10 years, maybe 15 years, there are some incredible realizations that he has found, and he's going to tell us about some of them now. So welcome, Akil. It's really good to see you again, my friend. How are you doing, first of all?
I'm very well, thanks. Really good to see you, as always, at the change of the seasons. And I'm really glad that we'll be spending some time together in New York at this amazing conference. It looks like a really excellent lineup, really a lot of things for people to think about. And what better year to think about it when it seems that everything is changing. So I'm really excited for that.
Yeah, it's going to be a tremendous time. Personally, in my work, I think we're going to get a really big acceleration in geopolitical cycles as we approach that time window. But this is not about what I think, it's about what you think. So, Akil, not everybody is fully familiar with your work with the 18.6-year cycle. So if we may, can we start off and just do an overview, an in-depth overview, so people who are watching your work for the first time get a feeling for it? And then, if we may, we'll have a look at where we are now. And then I've got some questions to ask you how this cycle may or may not be changing. So perhaps give us the big picture first.
Yeah, okay. I've sent over a diagram, which I wonder if we can put it up on the screen. Thank you very much. So I know that we've referred to it as the 18.6 year real estate cycle. I actually, in my book, also refer to it as the 18.6 year economic cycle, because what's going on in the real estate market ultimately drives what's happening in the economy. If people don't understand that, I explain that quite well in my book. It's to do with the fact that land is the most important factor of production. It's the one thing that we can't do without, one thing that everyone needs. It's very much fixed in supply, and therefore it has sort of monopoly characteristics. And it's also very linked to what the banking system does, which is essentially lend money for people to acquire real estate, be it residential mainly or commercial real estate. Um, and what we've found, if you study history, is that you have an 18.6 year on average, with actually very little variation, boom and bust cycle. So and essentially, what I try and show on this diagram, which is a very simplified illustration of it, is you have 14 years of expansion to a peak, and then 4 years of crash and depression and recovery. And then the cycle starts again. And that 14 years of expansion itself is roughly 2 7 year halves interrupted by a mid cycle recession. And then the mid cycle recession leads into the second 7 year half, which is much bigger typically, particularly the final couple of years, which are characterized not necessarily by really strong economic growth, though that sometimes happens, but more importantly, really significant speculation in all sorts of different areas of the economy. And that then brings on the peak and then creates the kind of crisis which is associated with a banking crisis or a currency crisis or a great financial crisis and a very significant economic recession. The recession at the end of the cycle is much more significant than the one in the middle of the cycle, which is also illustrated in that diagram. That's the basic overview. It explains the major periods of boom and bust in the economy. All the kind of major crashes in the stock market tend to be associated with either the mid-cycle or, more importantly, the end of cycle recessions. The US markets typically, and I refer to the US because we've got the best kind of historical data for the US. The US historically leads the cycle as well, and the stock markets appreciate beginning at the start of the cycle up to the peak. Typically several 100%, and they invariably fall by at least half at the end of the cycle. So major market events as well as economic and real estate ones as well. So
Okay,
that
that's
is the
oh, sorry. Can I just come in on that? You made a really important point there, that the markets fall by at least half. Sorry to interrupt you, but I'm sure people are wondering about that. So, whereabouts are you in this cycle seeing that happen? What's the warning point there, or were you about to tell us about that in a minute? And did I interrupt you at the wrong
No,
moment?
that's fine. Yeah, so you did ask where are we now at the beginning, and I sort of revealed it because I actually created this diagram in, I think it was 2016, and all I've done to change it over that time is I've moved that yellow dot across the graph. And so in 2016, it was somewhere in the middle of the first half, the first expansionary half of the cycle, and it sort of moved along, going up and up. And we're now kind of in the final couple of years, which I said is the most speculative part of the cycle, not far away from what I'm expecting to be the peak. And the reason why I think that's the peak is because it's 14 years after the start of the current cycle, which was sometime in late 2011, early 2012. And if you think back to that sort of period, people were still talking about kind of recession. You still had the Euro crisis in Europe. We had austerity in the UK and sort of pretty depressing state of affairs, if you recall that far back. The US and the US tends to be slightly ahead of the cycle, but nonetheless, it was still pretty difficult economically. A lot of anger, a lot of protests, and other things. But nonetheless, out of that, the current cycle started. We were expecting a slowdown 7 years in, around 2019, and we certainly were getting a slowing of the global economy in 2019, which was exacerbated by COVID in 2020. And in fact, the COVID response was what started the second half of the cycle. And so 7 years on from 2019, you expect a peak around 2026. There are sometimes variations of a year or two for unique kind of things that happen in a cycle. But I think as a basic framework to guide you, this is pretty strong.
Great. So let's drill down into well actually no. Let's so you said this works particularly well with the United States. How many years back have you taken this study to correlate all this data?
Well, you can go back to pretty much the beginning of the US, and it's actually documented in my friend and business partner's book, Phil Anderson. He wrote The Secret Life of Real Estate and Banking, which I also highly recommend that people watching this familiarize themselves with. So he's traced the cycle back to 1800 in the US, which is essentially the moment at which the US government, the federal government newly created after the War of Independence, started selling off the public domain to anyone who wanted to buy it out in the kind of the Western lands, as I think they were known then. And that kicked off a program of privatization of land, which then sort of resulted, and you can see this in the historical record of several years of speculation in buying and selling land and building and so on, that precipitated then a major crisis. So the cycle started in the early 1800s. The first peak was in 1818. The first major kind of financial crisis was in 1819. The thing started again. The next peak was in 1837, and then a financial crisis in 1836 was a peak. 1837 was a financial crisis, and so on. 1854, crisis of 1857, and so forth throughout the 19th century and into the 20th.
Fantastic. So let's drill down to where we are now. Can you sort of take us a little bit deeper into what because I know in your book, The Secret Wealth Advantage, you've really sort of analysed pretty much every year of the cycle. So what does your theoretical research say about where we are now as we enter? Well, we're well into 2025 now,
Yeah.
And then I'm going to ask you whether the current administration's policies and economic direction are varying that cycle, translating it, or are they actually underscoring the cycle?
Yeah, I mean, so what I try to do in my book is I break that sort of basic overview down into several stages, and I try and illustrate each of those stages with a different episode from history, including the last sort of decade, and then I sort of pose the question, looking at the historical record and going cycle after cycle, what are the common things you should look out for at each stage, the common developments, and then what should you do as an investor to take advantage of the opportunities or stay safe during the difficult periods. And so, what I say about the current period, it's the final sort of stage before the peak, which I call the mania. And what you tend to find is there's a lot of building going on, a lot of infrastructure, a lot of capital investment for often a dominant industry in the second half of each cycle. And actually, I go back to the 1840s in the UK 180 years ago, which you might feel is significant as well from a timing point of view. And it had the dominant industry then was the railroads, was entirely new technology, and a lot of capital investment, a lot of speculation. I chose that deliberately because I felt AI was the same thing in this current cycle. So you get a lot of kind of hope and excitement and a lot of investment around that. You get a lot of building infrastructure. Tall buildings is a very good sign of a cycle coming to a peak. You've had a number of announcements of the world's biggest building here, and it might not be tallest, but longest or whatever. The NEOM thing in Saudi Arabia, Oklahoma City is getting the tallest building in the US, if I'm not mistaken. You've got the tallest building in the world being built in Saudi Arabia, getting all sorts of different things along those lines. You often have speculation in certain types of stock or assets like stocks. So I'd say that Bitcoin and meme coins, even though they've come down a bit with some of this uncertainty, have done very well, and all sorts of nonsense going on like fart coins and other things like that. I mean, really, really sort of silly stuff. You get a lot of excessive, lavish behavior catering to the super rich because, of course, they've probably made most of the money in the expansion and so on. So you get a lot of news around that. And in general, you tend to find that there is a feeling that this time is somehow a different type of era. And I think, to go back to your comment about the new administration, I think they are effectively, in a lot of investor minds, creating that impression that somehow this era is very different to the one before, which is, for those of us who study cycles, is a big red flag. Because you know that cycles repeat. They don't repeat exactly, but they resonate. The timing's the same, and the themes are often the same. And that's the sort of thing that I try and show in my book.
Yeah, I think that's a really good point. Just putting this into sort of some degree of practical concept. If we go back to the 1930s or 1920s boom and bust, all the big skyscrapers were really being designed in 1925, and then we got the top on the 3rd of September 1929 in the stock market, and a very sharp crash ending in July 32. But the Empire State Building, I think you document this, wasn't it known as the Empty State Building?
That's right.
The Chrysler Building went up at that time as well, and they certainly in '87 we saw something similar in London, and this is something. So look out for it. If you see people building very tall buildings near you, then you don't even need to read books on science.
Yeah, I mean, one of the reasons why a tall building is such a infallible sign of the cycle peaking is that these things are massive projects, and you need a lot of bank finance, and they tend to be much more available towards the end of the cycle than at the beginning. You also need a lot of ambition and hope and euphoria at the end, which you get at the end of the cycle, because to conceive of this project and find people to back you is also requires the same kind of sentiment. And also you need high land prices such that building upwards makes the site pay better, because you're earning more rent on a piece of land. So those things come together very well at the top of the cycle, which is why you see that each time.
Fascinating. Yeah, that's a very valid point. So, as we record this, the stock market has seen more than a 10% correction, and but your cycle then suggests that. Let me ask you, what does your cycle suggest about this?
Well, it's not the case that markets and everything goes up in a straight line for 14 years. You of course have years when the stock market is not doing so well. I mean, 2022 was a very good example of that, and some of it is in response to political events, geopolitical events, or changes in interest rate policy or other sort of economic policy. Um, and I think what we have now is a situation where a new administration, it's very unusually for an American administration, or actually even any administration, they have had 4 years effectively planning for the next 4 years, which most governments don't have that luxury. They've come in with a very blizzard of changes. Some of them fairly radical, some of them actually fairly predictable. Things like loosening bank regulations and so on, and that's created quite a lot of turbulence. People have reacted, and it's not just that they've changed policy. They've kind of changed policy and then changed their mind, and then it's kind of this yo-yo kind of effect, which is, I think, leaving a lot of people a bit discombobulated, and so it does create a bit of turbulence in markets, and we've certainly seen that in the stock market. But in a sense, some people fear, dismantling the global trading system in the way that it has been functioning is quite a big change, and so a 10% correction in that context is maybe not quite as significant. I think part of that is because some of the other policies might be quite good for markets. So deregulation, if it's done well, which that's not always a given, but if it's done well, is good. Tax cuts, of course, are good for corporate earnings, and also might push sort of more money into the markets. And maybe there are sort of other things that the market is looking forward to. But I do feel, though, that sentiment in general, particularly for those of a Republican kind of preference, is very strong, and a lot of the kind of flow of money is coming from people with that political view. we don't tend not to think about investors as being political. We're just here to make money. But actually, I think your sentiment is very much affected by who you support. If you agree with the direction of policy, and I think some of the sentiment surveys I've seen recently sort of suggest that it is quite politically driven. So I think that's another way in which the administration is having quite a big impact on what's going on in the markets.
One of the things you mentioned earlier on, this last bit there, was the level of potential deregulation of the banking system that's coming in. Now, if I'm not correct, isn't this what happened under the oversight of Andrew Jackson, which did lead to the 1837 top?
Yeah.
Uh, Massive deregulation from 1830 to 1837 with the first national bank and the second national bank and so on.
Yeah, I mean, this is the thing. It's this is not a new feature. You often get a sort of deregulation of the banking system, particularly in the second half of the cycle. So what tends to happen is you have a major crisis. You then have quite a strict set of regulations come in to prevent the next crisis happening. They come in at the start of the cycle. That happened in 2011, 2012. And then the banking lobby being very powerful and having access to government officials in any country are always fighting to get some deregulation in, because of course some of the effect of the regulations is to stop legitimate lending, which is bad for profits. And so there's nothing sort of nefarious about it. It's kind of the normal ebb and flow of politics. It's just that it tends to be I wouldn't say a vote winner, but it helps people get re-elected if they've got the backing of the banking kind of lobby. And the first Trump administration came in saying that, and the second one did as well. And it's happening. There's delays to the implementation of Basel 4 or 3. I can't remember which one it is. And that's in the US. The UK is then delaying its implementation because the banking system does earn a lot of money in terms of profits and therefore in terms of tax revenue. So it's not surprising that this is happening all this time. The key thing, though, and the thing that people don't really understand is firstly that the banking system is responsible for creating most of the money in the economy. In other words, printing most of the money. I know that people talk about governments printing, but it's really the banking system that prints money. And the second thing is that most of that money that they print ends up in the land market or the real estate market. And that is the source of much of the fuel and the power of the second half of the cycle. And despite the fact there's been a lot of changes to interest rate policy and it's created a number of issues in the commercial real estate market, some of which would have happened anyway because people aren't working in offices and so on. It's really kind of what's driving the kind of speculative part of the this phase of the cycle. So yeah, I mean, it's kind of a fairly predictable part of what happens. And I've been writing about banking deregulation since at least 2016. So it's interesting that it's finally happening.
So one of the tools that's being used very emphatically is that of protectionism and tariffs. Now, there's several sides to this story. I mean, most of the public are not aware that several countries have already been imposing extensive tariffs in certain areas upon America and so on, and other nations. So now this is coming out as an economic weapon, and we've seen this before. We've seen such a thing going back. If we want to take the bigger cycles, or if we want to take your 18-year cycle and multiply it by 4, you get 72, and then you multiply that up again. Basically takes us back to the Embargo Act in 1807, where effectively America brought in tariffs on Europe, or it ceased to trade with Europe in an attempt to influence the ending of the Napoleonic Wars. And that was a big own goal, with the market being down 80%. Also, in 1890, 3 lots of 45 cycles back, we saw the McKinley tariffs coming in. In fact, this is one of the things that I think we're mirroring very closely. What do you think is going to be the outcome of these tariffs, and how does it fit in with the cycle?
Well, in a sense, it doesn't, because you have cycles where we've not had tariffs and it's continued. It's there are sort of fundamental forces at play which drive us through 18-year boom and bust cycles. as I've said, to do with the land market. And I talk about this in my book. Maybe we don't have time to do it now. The law of economic rent, which is one of the reasons why land is such a driver of what goes on in the economy.
Okay,
In that,
actually, do a quick overview on that because this is the key point, and then perhaps at the conference you can do a deeper dive. Can we give it
yeah,
just a
yeah,
little bit?
sure, happy to. I mean, it's a, it's a sort of concept that once you understand it, you can't not understand it. But it's sort of takes a bit of time to get your head around. But essentially, I mean, there's a number of ways in which I can explain it, but it's essentially that location matters. Location is very scarce. So, and when I say location, a good location where people want to live and work, or if you're talking about an agricultural economy, it's the most fertile section of the earth, and so on. Um, that the best locations are such because of the surrounding investment in markets and population and so on. And as a society progresses, the value of those locations go up, but the value accrues privately to whoever happens to be owning that land. So they've bought a piece of land, say in the center of New York. They do nothing with it, but because the population expanding, we're getting much more sophisticated as an economy, and so on. The value of that land goes up. That is effectively the law of economic rent. Rent takes all of the gains of economic progress, but the benefits of that accrue to whoever happens to own the land, which makes it great for collateral and lending. It makes it great for speculation and so on. That is what drives the boom and bust cycle. Because it's linked to the banking system, this is why it's so difficult to have any kind of credit at the end of the cycle and so on. It brings the banking system down. The businesses are starved of credit. In relation to policy, these things sit on top of these sort of fundamental forces and may affect it to a certain extent, but they don't eliminate the cycle. And so tariffs fall into that kind of category. I know that they seem to be this big economic tool and so on. They're not going to prevent the boom and bust cycle. And in fact, because they make economic activity harder, at the end of the cycle, they might precipitate a much more significant recession. So that's the risk. I think the problem is that Donald Trump, for all his sort of business acumen and so on, doesn't understand the 18-year cycle. And we know he doesn't understand it because every time you get a peak and a crash, he's always gets burned by it. And I think he came in his first administration and he imposed some tariffs on China and something. And to a certain extent, it worked because he got what he wanted. You can argue whether it was actually successful from an economic point of view. But we were at a different point in the cycle. We were in the first half of the cycle. Things were in an economically different place. As you get towards the end of the cycle, things get economically weaker. I'm not talking about where asset prices are and so on, but from a fundamental economic point of view, the economy is more stretched because land prices are higher. And my fear is that tariffs won't have the same effect and actually might be the thing that ends up precipitating a much more significant recession than you otherwise would. Because one of the things we found in after 2008 that got the economy going again was the fact that the international system held up. You had China stimulating, you had America stimulating. That pushed a lot of money into the global economy. That China and the US were able to go out into the world and buy goods, and that kind of got the thing going. Now it was imperfect. I definitely would agree with anyone who would make that objection, but nonetheless, that was one of the sort of mechanisms by which we got out of the major financial crisis. If you have a system which is falling apart because everyone's fighting with each other, imposing tariffs and making economic activity harder, at the end of the cycle, it's not going to work in quite the same way. So I think that's the kind of the effect that kind of policy will have on the cycle. It won't change it, but it might kind of change the kind of pathways to getting towards the peak and into the kind of crisis period towards the end of the decade.
So you say we could really potentially, whilst the cycle remains intact in terms of time, the magnitude or the extremes of the cycle are likely to be greater.
Yeah, I mean, we talked about banking deregulation earlier. I mean, so banking regulations were also reduced in the sort of 90s and 2000s, and that enabled much more sort of money to be pushed into the real estate market into the peak in 2007. if you didn't have that level of deregulation, you wouldn't have had quite the same level of speculation in real estate in the 2000s. So it can amplify or kind of reduce the size of the boom and therefore the subsequent bust. I think you in this particular sort of iteration of the cycle, you could argue that the really high interest rates has put a sort of lid on really excessive property speculation, and so it's now taking different forms in the current cycle. You've had sort of ridiculous sort of episodes of boom in the crypto space. You've had a lot of money pushed into sort of private credit, which was not seen in quite the same way. You've had private equity models changing, but still going towards speculative activity. It's just in a different way, and you'd say that maybe the locus of speculation in real estate is more concentrated in the Middle East and parts of Asia this cycle than it was in the last one, which was very much in parts of America, Europe, Southern Europe in particular. And so it can change, where things happen and the degree to which they happen, but it won't fundamentally change the fact that it's going to happen in the sort of timing in the way that is described in my book and elsewhere.
And so, with regards to your study of this cycle, Akil, have you noticed any sort of alignments with, say, geopolitical conflict or more harmonious times and more tense times?
I mean, the 18-year cycle goes through very sort of different eras. So it starts in the US the start in the US, but you can see in the US in 1800 agrarian economy, highly sophisticated, technologically advanced economy. Now it's gone when interest rates have been low. It's when interest rates are high, low and high inflation and so on. The geopolitical effects that have interrupted the cycle have been the two world wars. And so it's not the case that the cycle carries on regardless. It does take place in a global economy where other things are going on. And if we're all fighting each other, then we're not going to be doing our normal economic business. So that's one sort of thing. The other thing is, and I write about this in my book, the only other cycle I write about in my book is the long cycle, the Kondratiev wave, which is a 55 to 60 year cycle. And that is also peaking around the same time as the current cycle. And that's much more associated with both technological change and disruption, but also kind of international conflict and internal revolution. And so it's really not surprising that we've had this kind of pressure on the global system as we've had in the US and China, essentially through various proxies, you'd say fighting with each other. And also that you've had in a lot of Western countries in particular, a lot of internal struggles. I mean, this is again associated with the peaking of the long cycle in the same way that we saw in the 60s and early 70s, which was the previous equivalent period for the long cycle.
And let's just point out to people viewing this, and especially those studying cycles like we do, that we take the 18 to 18.6 year cycle, we multiply that by 3, and that takes us to 54 to 55 and a half years. Yeah. So we've got a 55 Fibonacci number there, and we've got the Kondratiev wave, and of course that also ties with some more
wheels within wheels.
Yeah, like the Metonic cycle and so on.
Yeah.
So we're pretty exciting times really coming up, aren't they? Do you see an acceleration of excitement in the world over the next few months, or do you think it's going to settle down quite soon?
I don't feel that we're going to see things settling down. What might change though is the kind of daily coverage in the news. So it might seem to settle down, but so you've had a sort of very significant change in direction as of January. That will obviously create a counter reaction. It already has to a certain extent, but I think we're still seeing some of that sort of play out. Whether that's done in the news or behind the scenes, I don't know, but it's certainly a fragmenting kind of world. And it's, what you get in these situations where there's not much stability is people react and things can change quite quickly. So I feel we're in that sort of period now. And so the excitement, if that's what you want to call it, will continue, which might make markets quite volatile. You'd have to say the opportunities on the both sides of the market. Should we say it's not just going to be necessarily a nice uptrend with predictable corrections along the way and so on.
And if we zoom out a little bit, if we zoom out a lot, are we seeing some degree of empire change here, not just with America, but say China and other nations as well? Are we seeing a change in order of the empires in your study of cycles?
Yeah, I mean, I've looked into some of that. People talk about 250-year kind of empire cycles, and they Ray Dalio and others have documented some of these things and what happens when an empire comes to an end. Um, I don't. I mean, from a practical investment point of view, I find those things interesting, but maybe not quite so practical. Um, so I certainly think that whether you'd say that the American empire, or maybe it's more accurate to say hegemony, is changing or not. I mean, I think that's certainly the case. We had a situation, particularly after the Second World War, where at least in 1945, the US economy was basically half the global economy. Clearly, that was not going to change. Sorry, that was going to stay the same for any lengthy period of time. Um, and in recent years, if anything, the US dollar has become more important rather than less, and that's partly because of the rise of China and China being quite heavily dependent on the dollar, and that's created this enormous importance for the US dollar, or partly responsible for that. But we are then seeing the other side of that, which is basically that people realize that the American government has a lot of power because of this, and they don't like it, quite understandably. And also at a time when probably, if we were to look at it in a serious way, the Chinese economy is, I think, quite substantially larger than the American one. I know that sort of nominal GDP in US dollars changes that, but the US dollar has been strong. When the US dollar weakens, and if you were to do it in purchasing power parity terms, I think you'd see that quite clearly, that China is, as an economy, much larger than the US. And also, as we're seeing now, quite technologically sophisticated and able to produce these kind of breakthrough technologies, and also do things in a smarter or cheaper way than American companies have come up with. And so they have a real rival, and it's not just China; it's also India is trying to reform and rise rapidly. And if you take the sort of South American countries together, I think their economies collectively are enormous as well. Um, and so we're certainly getting a fragmented world, or a multipolar world, or whatever you want to call it. And that means that American hegemony is inevitably going to decline. Um, whether it's timed cyclically and so on, and you could say it's an end of an empire or not. I mean, I tend not to think of it in those terms, but things are definitely changing. There's no question about it. And so some of the truths of the last sort of 40 or 80 years are going to change. Now, I have to say, people talk about the last 80 years and this liberal international order and all this kind of things, this sort of period of consistencies and so on. I mean, if you look at the history, it's actually not like that. There was a lot of turbulence in the 60s and 70s around the Vietnam War, and America effectively, maybe we shouldn't say this to this audience, being defeated in Vietnam. I mean, this was an enormous blow to American prestige and people on trying to actively sort of move away from the dollar. I mean, the Bretton Woods system ended. Actually, that was the US that ended it. But trying to create other currencies. There's always these kind of periods of sort of testing and so on. And I think the only time when you would say sort of that American empire was there for and everyone sort of recognized it and followed it was probably the period from 91 to 2001. I think that was the only period. After that, it all sort of, before that, it was obviously divided into the Cold War camps of the US and the Soviet Union. After that, after the sort of Iraq invasion and other things, and the rise of China, it was being tested again. So I think we tend to impose narratives on the past because we don't understand or forget some of the detail. I think I'd sort of caution people to be too swept up in these grand narratives, which I don't think are actually always entirely correct.
Of course, the truth is, if you study cycles, you do tend to see through some of these uh, smoke screens or facades. So tell us what we can look forward to hearing from you when we're in New York, or is that a secret?
Well, you see, I'm sort of slightly cautious about saying what I'm going to say when the world might be very different in 3 months' time. Of course, I think the most important thing that I can do for people who attend is to take them in more detail through the cycle, because I think we are entering a very important time. I think I want to help people get prepared for what's to come, and so I think that's the important sort of thing. So stick to the basics, stick to the things that I know most about. Um, I think I'll do a bit more on the long cycle. I think that's quite important. And then I'm happy to wait to see what other events transpire to sort of kind of talk about how they fit in, because I'm sure that people have a lot of questions about those.
Fantastic. So, Akil, thank you so much. Before we wrap this up, let me just remind everybody 12th to 14th of June this year, just before the next season, we will be meeting at SUNY up on East 55th Street in Midtown in New York. It's a beautiful area. I've spent an awful lot of time, mainly because I used to stay on East 55th pretty much every month when I was out there. It's going to be tremendous. There's some fantastic restaurants and bars nearby. We're going to get time to interact. And as I say, we've got some very special guests, one of whom is our very own Akhil Patel. We've also got Larry Williams coming in. We've got Peter Eliades. We've got Sherman McClellan. And we've got pretty much most of the board speaking as well. So it's going to be a tremendous occasion. Please come and join us. It's very, very reasonably priced. We do want you there. And of course, the best thing, not only are you going to be able to listen and observe and these incredible presentations, we're going to be able to interact with each other. So it's going to be tremendous. So we're looking forward to seeing you out there. I personally also believe that the world could well be very different only in 80 days' time, whatever it is. But let's bring this to a close then. So Akhil Patel, from Property Share Market Economics, author of The Secret Wealth Advantage, also big business partner of our dear friend Phil Anderson, author of The Secret Life of Real Estate and Banking. They run Property Share Market Economics together. Go and look at their resources. Come and look at our resources at the foundation as well. We're really on a big push now under our leadership, under the leadership of our Dr. Richard Smith. We really want to take this foundation out there, get the word out, and make the world a better place. So, Akil, thank you so much for joining us. Thank you for what is really more than a teaser. I think there's a lot of value in this presentation, and we're probably cutting it short now because I know you and I sit in this room or wherever we meet up in London or whatever, and what's supposed to be a 1 hour meeting, lasts from lunchtime all the way through to the early evening with some nice red wine as well. But maybe we'll do that again in New York. So thank you so much, Akil. Really appreciate you taking the time to talk to us, and we look forward to seeing you all in New York on the 12th to 14th of June. Now, go onto our website, cycles.org, and fill in the form. Get yourselves. There's only a limited number of seats available now, so please do that. All right. Thank you very much. Thank you, Akil.
Thank you.